If you walk down the high street of any major city in the Western world today, you will notice a strange and unsettling paradox. On the screens and the shop windows, the news channels report that the stock markets are near all-time highs, unemployment is relatively low, and the GDP is technically growing. But if you look at the people walking past those windows, you see a very different reality. You see the stress etched into their faces as they congratulate the price of a sandwich that now costs nearly double what it did 3 years ago. You see for lease signs multiplying like a fungus on commercial storefronts. You feel a pervasive sense of dread, a collective intuition that despite what the politicians and central bankers are saying, the ground beneath our feet is cracking. Is cracking dissonance, the gap between the official economy of the rich and the lived-own economy of everyone else is not an accident. It is the visible symptom of a structural collapse that began almost 2 decades ago, but was deliberately hidden from view. We are not merely in a recession, we are at the end of a specific economic era. For 15 years, the global economy has been kept on life support, pumped full of artificial adrenaline in the form of cheap debt and printed money. Now the life support machines are failing, and the patient is waken up to a terminal diagnosis. To understand why this is happening now, in 2025 and 2026, we have to look past the headlines about supply chains or wars and focus on the single most important price in the world, the price of money itself. For most of human history, money had cost. If you want to borrow capital to build a factory or buy a house, you had to pay an interest rate that reflected the risk of that loan. This interest rate acted as a filter, a gravitational force that kept the economy grounded in reality. It ensured that only productive, profitable businesses survived. If a company couldn't make enough profit to pay the interest on its loans, it went bankrupt. Its assets were sold to someone more competent, and the economy evolved. This is the creative destruction of capitalism. But in 2008, following the global financial crisis, the central banks of the world decided to break this mechanism. Terrified of a deflationary depression, the Federal Reserve, the European Central Bank, and others slashed interest rates to zero, and in some cases below zero. This was the birth of the zero interest rate policy, ZIRP era. It was intended to be an emergency measure, a shot of morphine to get the patient through the night. Instead, it became a prudent lifestyle. For 15 years, money was effectively free. This distortion of reality created the everything bubble. Because you couldn't earn any interest by keeping money in the bank, trillions of dollars were forced into risky assets. Real estate prices skyrocketed, not because houses became more valuable, but because mortgages were cheap. The stock market detached from rings. Cryptocurrencies with no utility ballooned into trillion-dollar asset classes. But the most dangerous side effect was the creation of a new species of corporation, the zombie company. A zombie company is defined as a business that earns just enough money to continue operating and throws the interest on debt and not enough to pay off the principal. In a normal economy, these companies would die, but in the ZIRP era, they didn't have to die. They could simply roll over their debt. If a loan came due, they would borrow new money at 1% interest to pay off the old money. They were the economic undead, consuming resources, labor, and capital, but producing no growth. By 2024, estimates suggested that nearly 20% of all companies in the United States and Europe fit this definition. They were ticking time bombs, safe as long as rates stayed at zero. Then came the inflation shock of the early 2020s. The massive money printing used to stimulate the economy during the pandemic finally broke the dam. Prices for energy, food, and housing exploded. The central banks realized that lost control, were forced to slang on the brakes. They raised interest rates faster than any time in 40 years. This was the moment the music stopped. The free money era ended overnight, but the debt that was accumulated during that era remained. Now we are facing the maturity wall. Trillions of dollars of corporate and commercial real estate debt taken out when interest rates were near zero are coming due in 2025 and 2026. These loans need to be refinanced, but instead of borrowing at 2%, these companies are facing rates of 6%, 7%, or 8%. The math simply does not work. A zombie company that could barely survive at 2% is instantly insolvent at 7%. We're seeing the first waves of this impact in commercial real estate sector, or office towers that were once valued at hundreds of millions of dollars are selling for pennies on the dollar because the owners cannot afford the new mortgage payment. This is why the economy feels like it is collapsing, because the artificial mechanism that held it up has been removed. The wealth that was created over the last decade was largely an illusion of valuation driven by cheap credit. As that credit evaporates, the valuations are collapsing back to reality. The pension funds that invested in commercial real estate, the banks that lend to the zombies, and the governments that relied on tax revenues from asset governance, while realizing that their balance sheets are full of holes. The global economy is not just slowing down, it is detoxing for the great debt binge in history. In an age of going AI, the central banks brought in nightmare scenario. The EU waits to feel the zombie. Inflation will return the vengeance. If they keep rate high to fight inflation, the zombies will die, dragging the banking system down with them. If the end of zero interest rates is the trigger, the ammunition is loaded in two specific sectors that are currently imploding in slow motion: Chinese real estate and Western commercial offices. These are the twin pillars of the global asset bubble, and they are crumbling simultaneously. Let's start with China. For 20 years, China was the engine of global growth. It consumed the world's steel, copper, and cement. But that growth was built on a Ponzi scheme of property development. In China, real estate isn't just a place to live. It is the primary savings account for the population. 70% of Chinese household wealth is tied up in property. Developers like Evergrande and Country Garden pre-sold millions of apartments that they hadn't built yet, used that money to buy more land, and borrowed billions from international banks. It worked as long as prices went up, but now the bubble has popped. Millions of apartments sit unfinished, the developers defaulting on their debts. The average Chinese citizen has seen their life savings evaporate. This triggered a balance sheet recession. The people feel poor, they stop spending. China is now exporting deflation to the rest of the world. They are dumping cheap electric vehicles, solar panels, and steel under global markets in a desperate attempt to keep their factories running, crashing prices for manufacturers in Europe and America. The China reopening story was a mirage. The dragon is sick, and its thickness is contagious. Now look at the United States, Europe. Here the crisis is in commercial real estate, CRA. The pandemic permanently changed how we work. While work from home didn't just empty offices, it destroyed the economic model of the skyscraper. In cities like San Francisco, New York, and London, office vacancy rates have hit record highs. But the crisis is hidden in the accounting. A building that was worth $500 million in 2019 might be worth $200 million today, but the owner hasn't sold it, so the bank still lists the loan as performing at the old value. This is extend and pretend. But in 2025 and 2026, the loans mature. The owner has to refinance. The bank says, your building is worth half what you owe. Pass the difference. The owner walks away. Keys are being mailed back to lenders across the country. This is a direct threat to the banking system. It is not the giant, too big to fail banks like JP Morgan that are most exposed. It is the regional banks. These are the small and medium-sized banks that hold the vast majority of commercial real estate loans. When these loans go bad, these banks will fail. We saw a preview of this in 2023 with Silicon Valley Bank. That was a tremor. The earthquake is coming when the $1.5 trillion maturity walls. The contagion effect is terrifying. If regional banks fail, small businesses can't get loans. If small businesses can't get loans, they fire workers. Unemployment rises. Meanwhile, the governments of the West are in no position to bail them out. They're already running record deficits just to pay the interest on their own debt. We're entering a doom loop where the banks own the government's debt, treasuries, and the government guarantees the bank's deposits. If one falls, they both fall. The global economy isn't collapsing because of a single event. It is collapsing because the collateral that underpins the entire financial system, real estate and government bonds, is losing its value. In the final section, we will discuss the end game. How will the authorities respond when the banking crisis goes global? They have one tool left, and it isn't interest rates. It is total control. We will look at the rise of central bank digital currencies, CBDCs, as the money solution to the crisis, a way to trap capital in the system and force you to spend. We have established that the global economy is caught in a pincer movement. On one side, the everything bubble is deflating as interest rates return to normal, threatening to wipe out the zombie companies in the commercial real estate sector. On the other side, the banking system is sitting on trillions of dollars of unrealized losses, making it too fragile to withstand the shock. In previous crises, 2001, 2008, 2020, the central banks had a simple playbook: cut interest rates and print money. They acted as the lender of last resort. But in 2025, that playbook is burning. The central banks are trapped in what economists call the trilemma. They cannot fight inflation, support the banking system, and fund the government's deficit all at the same time. If they print money to save the banks like they did in 2008, they will reignite the inflation fire that is already destroying the middle class. If they keep rates high to kill inflation, they'll bankrupt the government, which cannot afford the interest payments, and crush the real estate market. They are out of ammunition. When a government runs out of economic solutions, it inevitably turns to political ones. We are moving from the era of market management to the era of financial repression. The end game is not a sudden Mad Max-style collapse. It is a slow, suffocating tightening of the control grid. The authorities realize that the current debt load, global debt is now over $315 trillion, can never be paid back in honest money. It must be liquidated. Since they cannot default, which would destroy the system, and they cannot pay it, which is mathematically impossible, they must inflate it away while preventing you from escaping the burning building. This brings us to the most significant monetary shift since the creation of the Federal Reserve, the introduction of central bank digital currencies, CBDCs. For years, CBDCs were discussed as a boring technical upgrade, a way to make bank transfers faster. This is a lie. The digital dollar, digital euro, or digital pound is not money as you know it. It is a surveillance and control tool disguised as a currency. In the current banking system, if you lose faith in your bank, you can go to the ATM, withdraw cash, and put it under your mattress. This act, the bank run, is the market's way of punishing bad banks. It is the ultimate check on power. With a CBDC, physical cash is eliminated. You cannot withdraw your money. You can only move it to another digital wallet within the government system. This gives the central bank absolute power. If the economy is slowing down and they want you to spend, they can implement negative interest rates. They can program your money to degrade by 1% a month. You're forced to spend it or lose it. If the supply chain is broken and meat is scarce, they can program your wallet to only allow the purchase of 2 pounds of beef per week. This is programmable money. It transforms the currency from a store of value into a system of social engineering. We are already seeing the soft launch of these controls. Look at the war on cash in Europe and Australia, where limits are being placed on how much physical cash you can use for transactions. Look at the debanking phenomenon, where politicians and dissidents are having their bank accounts closed for reputational reasons. The infrastructure for total financial control is being laid right now under the guise of fighting money laundering and terrorism. The collapse of the old economy is the perfect excuse to introduce the new one when the next banking crisis hits, likely triggered by the commercial real estate implosion we discussed. The government will not bail out the banks with taxpayer money, which is unpopular. They will bail in the system by forcing everyone onto the Fed's digital ledger. They will say it is for your safety, to protect your deposits. In reality, it is to trap your capital. This shifts the entire psychology of investing. For 40 years, the goal was return on capital. How much profit can I make? In the new era, the goal is return of capital. Will I get my money back and all? The smart money, the billionaires, the sovereign wealth funds, the family offices, is already positioning for this. They are buying hard assets. They are buying farmland. Bill Gates is the largest private farmland owner in the U.S. They are buying gold. Central banks are buying it wreck at Reese. They are buying energy infrastructure. They are exiting the financialized economy of stocks and bonds and entering the real economy of things that cannot be printed. They know that when the debt bubble finally bursts, the only things that will hold value are assets that have physical utility, scarcity. The paper wealth of the middle class, the 401k filled with overvalued tech stocks, the bonds paying less than inflation, will be the fuel that burn to keep the system running a little longer. The global economy is fertily undergoing a great reset, not the one conspiracy theorists talk about, a reset of valuations. The standard of living in the West, which was artificially inflated by cheap goods from China and cheap debt from the Fed, is reverting to the mean. We are becoming poorer, but the numbers, GDP, stock market, are being manipulated to hide the decline. The ultimate casualty of this collapse is trust. Trust in the banks, trust in the currency, and trust in the social contract. When that trust breaks, the economy doesn't just receive, it fragments. We are heading toward a world of parallel economies. The official economy of CBDCs, taxes, and surveillance, and the gray economy of barter, gold, crypto, and under-the-table labor. The window to prepare is closing. The maturity wall of 2025-2026 is the catalyst. The banking crisis is the mechanism, and the digital dollar is the trap. The question is not will it happen. The math says it must. The question is, where will your wealth be when the music stops? Will it be in a digital token that the government can turn off? Or will it be in something that you actually own? Series Duacticone. We talked about how the economic system is rigged to trap your wealth and inflate it away. But sunshines, when the government is truly downward, they butter with inflation or digital tricks. They just kicked down the door. In 1933, the United States government, the land of the free, faced a banking collapse similar to what we are seeing today. To save the system, they decided they needed your money, specifically your gold. Franklin D. Roosevelt signed Executive Order 6102. He made it a felony to own gold coins or bullion. He forced Americans to turn in their life savings in exchange for paper money that he immediately devalued. It was the largest state-sponsored theft in American history. In the next video, we are going to tell the full, uncensored story of the Great Gold Seizure. We will uncover the secret prosecutions, the legal loopholes the wealthy use to escape, and the terrifying legal precedent that allows the president to seize your digital dollar, gold, in 401k during a national emergency. You need to know your safe is actually safe. Smash that like button to keep the signal alive and subscribe so you don't miss the history of the gold ban. I'll see you in the vault.